Okay, well, welcome back. We're going to move on now to banking. That's still opium, other people's money. It just takes the form of banking. And I'm going to use banking in the generic sense. I'm going to include any financial institution, whether it's actually a legal bank, a state bank, a federal bank, a local bank, a credit union, or anything else. All right. Now, the keys to the vault. The keys to the vault of the bank are planning and accounting, planning and accountability, apparent ability to repay. This is the number one thing. The number one thing, the key to the vault, is planning and accountability. Banks lend by the pound. They actually lend by confidence. It's a very emotional thing for a bank. Banks can or cannot make loans based on the fair market value of collateral, but that's the second decision. The first decision is, do they want to or not? And that's the apparent ability to repay. And they gain that either through historical performance, and oftentimes that's interesting, but it's often not relevant to this precise situation today. So they want to know what your plan is. And that's why we spent the first hour or so of this exercise working on the value and techniques and process for planning. All right. The other thing is actual performance and accounting. Now we're going to grind our axe here a little bit. Accounting systems, procedures, policies, and controls are intended to not just educate you, but to educate everybody else around you about how are you doing. You keep going back to them and giving them information, even if it's negative information or difficult information. The fact that you know it, the fact that you're working on it, and the fact that you're getting control of it will keep the keys to the vault, opening the doors for you. All right. The lending decision. The executive committees of banks are guys like you, women like you, who get together periodically, often it's Wednesdays, some banks it's Tuesdays, and they look at all the documents that are given by the executive committee and or the lending executive. He's the salesperson. He's the one that gathered all the stuff up from you. He's your banker. They're looking at all that stuff, and they are, in a very short space of time, listening to that banker make a presentation on your behalf about your apparent ability to repay. And secondly, the collateral base against which they have this safety shield to protect themselves from failure. That's the theory, in spite of what we saw in the last year or so in the banking industry. That's what they're supposed to be doing. Now, that said, well over, in my experience, and I've coached, been a part of, made presentations to, and heard from executive committees, well over 80% of the decision to lend or not is apparent ability to repay. Now, there are basically a couple of kinds of loans. You probably already know about these. There's term loans, and there are revolver type loans or lines of credit. The term loans, by their very nature, tell you the story. Repayable over a certain term. A car loan is a typical term loan. 60 months, 36 months, I suppose these days with the cost of cars, 84 months, anything like that. But that's a term loan. Term loans usually are the precipitant result of lines of credit that didn't quite work out right. That's been my experience. Typically, lending is done either with an eye toward a particular job in the construction industry. We will secure this lending by your real estate, by your personal guarantee, by something or other, and it's a line of credit tied to that particular job or these particular jobs. The job goes on, things get done. Sometimes things don't go according to plan. The line of credit doesn't get fully repaid and ends up becoming part of a term loan. We term that out. Now, in terms of your balance sheet, if you have assets and liabilities, you have current assets and current liabilities, longer-term assets and longer-term liabilities. The way to keep it in balance is really to keep your borrowing to match the purposes. So if you're using short-term cash and receivables and inventory, in your case work in process on jobs and so forth, if you're incurring that, you may well be using lines of credit, vendor, supplier credit, and so forth to keep that in balance. If because of a lack of profitability or something, that doesn't quite happen. Frequently, the line of credit will be termed out. It will become almost like capital, but it gets repaid over a length of time. Similarly, if you have to buy a piece of equipment, a large truck, a crane, a backhoe, any one of a number of things like that, you may end up with a longer term loan. That's bank credit. That's it in a nutshell. Those are what bankers do. Now, one of the problems with banks over time is they get a little bit loose and a little bit familiar. And that's a good thing when you're in business. I've been in business in several different businesses, and that's a good thing because you can dial them up and say, hey, Bob, I need another $50,000 put in a checking account, put it on my line, and he'll say, fine, Joe, that's great. And away you go. But over the course of time, when those get renewed, sometimes bankers aren't quite so careful about documenting what their commitment is to you for the future. And you want what I'll call a synoptic letter from the bank. Periodically, 6 months, 9 months, a year, no less often than a year anyway, you want them to confirm to you what the status of your loan situation with them is. If they are reticent, if they're reluctant to do that, then that's a clue. Then you know that you're headed out into some thin ice as far as they're concerned. But for example, at the end of the year, you renew the notes and all is well. But you have in mind, through your budget and financial plan that you presented to them, the need for another $400,000, and they've said, fine, we won't have any problem with that. Well, that's not quite good enough. We want that reduced to a letter of acknowledgement. What are the terms? Exactly what am I going to have to do to get that $400,000? Exactly what is the repayment plan going to be? Exactly how long are you going to need it? What kind of financial statements are you going to need for that? How often and all that? Again, you appear to him to be a professional manager, and that's what you want to be, because that's how he wanted you in the first place to be, as someone with the apparent ability to repay. So have them reduce that to a written synoptic letter. Now, guarantees. You probably know this, but a lot of banks require, when a closely held business goes and borrows money, the guarantee of the personal owner. And they will often say, well, we want to know that you're in this just like us. Not really. They want to know that you're in there instead of them, if need be, okay? Bottom line is, they will ask you to exercise blanket unlimited personal guarantees. Well, I'm not real fond of those. Sometimes they're requisite. Usually people execute them without reading them. I never do that. I've owned 4 different businesses. Every bank I've ever dealt with has given us personal guarantees. They've all read slightly differently. Remember, they paid an attorney $300 an hour to draft that puppy. The least you should do is read it before you sign it. And if there's something that's totally offensive in there, the time it's most negotiable is when it's in your hand before you sign it, not after. Now, one of the other points is collateralizing personal guarantees. Well, we don't really like to do that. Until the personal guarantee is called or becomes apparently needed, we'd rather not collateralize it, but often, as a part of the ordinary course of business, banks will not only ask for personal guarantees from owners and officers, they will ask for collateralization for the guarantees on a standby basis, a real estate security agreement or something like that. That's an encumbrance. It's an encumbrance to your way of doing business, to your personal life, to the whole concept of containerization of your investments, and so you want to be averse to that. You want to not have to do that unless it's absolutely necessary, and so you want your coach, your accountant, your attorney, and the banker to get together and figure out if there's some way you can accomplish what you want to do without it. But if you can't, then make sure that it's got the least offensive terms in it, and if you can't, then resist collateralization, and if you can't, then make sure the collateralization is done on condition. That is to say, the release of the collateral for the personal guarantee will be on the following conditions: obtaining budgeted planned profitability for no less than 3 consecutive quarters. I tend to reserve the 4th quarter for tax manipulation. All right, that's when we want to maybe do some tax planning and eliminate taxable income. So if I'm negotiating the release of collateral for a personal guarantee, I'll want it to be something less than year-end performance, but if it absolutely has to be, then at the very least I want it to be released upon attainment of year-end performance or consecutive years or quarters of performance. But I want recitation about how am I going to get my collateral back, and I want to know when I'm getting my personal guarantee back. They don't want to talk about that, but I'm saying to you that if you have the apparent ability to repay, you are a customer they really want, and they're willing to make a commitment, then let's get the rules of the road all nailed down. Okay. Now, one more point about guarantees, and then we're going to move on. The unlimited personal guarantees, joint and several among 4 owners. Typically, if there's $1 million in debt, I ask the owner, how much is your guarantee? He says $250,000. Wrong answer. Right answer, 1 million times 4. That is to say, each one of you has 1 million. And well, they can't come and get it from me unless they go and get it from them. Wrong. The bank takes the path of least resistance and lets everybody else to their own devices. So if there are 4 personal guarantors of $1 million corporate debt or business debt, they don't each have 250. The one with the deepest pockets has $1 million, and so does everybody else. The one with the deepest pockets is the one who the bank will go to first. The one with the personal guarantee that's most liquid is the one they go to first. Therefore, you need to caucus with the other 3 and say, look, yeah, you guys are all on it, but it's really me. What am I going to get for that? Well, what do you mean, what are you going to get for that? You already own 25% of the company. I know, but that's a separate issue. I am now going to be the deep pockets that provides a collateralized or uncollateralized personal guarantee. Clearly, by sharing our personal financials, it's obvious that I'm the liquid one, you're all on it, but I'm going to have to sue you at best to get whatever's left of what you got, if that gets to that. So it's only fair that I should get a fee for doing that. Think about it. Sometimes it's appropriate, sometimes it isn't. But even if it's just you, and you're guaranteeing the corporation's debt, keep in mind, fees for personal guarantees are not earned income, not subject to withholding tax, Social Security tax, and anything else. And the standard is arm's length, somebody on the street, what would they get for doing that? So if it's $1 million and you're going to guaranteeing it, what would somebody on the street have to get to guarantee the debt to this corporation? Well, I wouldn't touch it with a 10-foot pole. Well, then why are you even doing it? But what I mean is, if $2,000 a month, at least in the beginning, for the risk involved, is something somebody else would at the very least charge to render a personal guarantee, even if it's collateralized by the assets of the company, then shouldn't you get that? And that's not a dividend, it's not interest, it's not earned income. It's pretty cool. All right? It's a fee for personally guaranteeing it. It has to do with rendering passive assets to accomplish the lending. And that's why I want to get a little technical here, and that's why I'm slowing up. Passive or portfolio income for you, so you need to be careful about that. That's a whole tax issue, but bottom line is if you're going to render your personal guarantee, get paid for it. Or at least get owed for it. All right, now we're going to move on to where else to go get money. So we so far have dealt with you yourself, out of your own accumulated savings, which you're averse to because you want to containerize your money. Other people who are silent partners, but we know they aren't, so we're going to reduce whatever agreement we have to them with writing. We're going to plan a way out for them. We're going to make sure that we have it well documented and so forth. Or it's banks, and if it's banks, then we know we want them to reduce routinely and periodically their commitment to us to writing. And if it's going to be guaranteed, then we know we want all that stuff done. But there's more. There are other places, and there are increasingly more places. And Wisconsin is a particularly fertile place for this because the government is worried. That Wisconsin doesn't have as friendly a business posture politically and financially and tax-wise as it might otherwise have. And so they've created a whole array of places that are, I'll call government and pseudo-governmental lending opportunities. Now, you have this sheet, a big one, or you should have this big one among the things that you got. For those of you who have DVDs, these will be provided as part of the PDF files or something with the DVDs. But we're going to talk first about, well, it's actually typed wrong on there. It says MDEC. It should say MEDC. And what that means, and that's not on your sheets, is in particular for Milwaukee and the Milwaukee area, we have a thing called the Milwaukee Economic Development Council, and they make grants and loans both. They typically like to make loans, but they make selected loans. They tend to want to focus on people doing business specifically in the Milwaukee County area, and that doesn't mean your headquarters have to be there. That just means that that's where you're doing a lot of your business. They have a whole array of really nifty grants and term loans. Generally, they try to make them be term loans. Remember, a term loan is a loan that's X number of months and so forth. They don't like revolving lines of credit and all that. But the Milwaukee Economic Development Council started off in real estate, so this is especially relevant to us. It started off doing almost always just real estate loans and had now gone on and moved on to working capital lending and a variety of other things. They are a really good outfit. Now, SBA. Overview very quickly. In general, there are two kinds of SBA loans. The first is a direct loan, and direct SBA loans are like hen's molars. First you have to find hen's teeth, and then they have to be molars. They are very difficult to get. They're very difficult to find. They are expensive to process, and the paperwork is no less than 3 inches thick, and they want rights to your firstborn, as well as the right to intervene on virtually any of the business decisions that you make when you run it. But that's not a bad thing if you're running a professional business. Direct SBA loans tend to reserve for minorities of one kind or another, or for lending to accomplish investment into minority areas, like Milwaukee maybe. All right, the other kind, and the one more common, and the one about which most of us know, are what are called in the second column over there. If you look in the second column from the left, SBA 7A, regular CLP, PLP, low doc, pre-qual, and SBA express type loans. A lot of banks handle these as a specialty. The reason, why would a bank bother? Well, it results in a guarantee. The SBA virtually guarantees the loan for the bank. So if the bank makes you a $100,000 loan, and generally they don't go less than 70-75% guarantee, because if they can't guarantee it at least that much, it's usually a risk they don't want to take. But it becomes a guarantee, so the bank gets an insurance policy that says if you fail, the government will pay. All right, that's pretty neat. The application paperwork is fairly simplistic, pretty easy, and one caveat though, the loans are up to $2 million. The guarantee limits are 85% up to 150, 75% on loans over 150. The purpose is to provide loan guarantees to lenders unable to provide conventional financing. Well, I wish that were totally true. They're able, they just don't want to. Or they became part of the SBA program for the guarantees because why not? This is a good borrower. Well, if you're really a good borrower, maybe you don't need the SBA, but you might want it anyway because then the bank can concede interest rates and terms. They can generally give a little bit better terms and a little better interest rates. They are much less intrusive in how your business runs. They don't have much to say about it, and it can be used for virtually anything. The only thing it can't be used for is to replace an existing loan. The bank can't take an existing $600,000 loan and convert it to an SBA loan. At least that's the theory. However, if you need $1 million and you have $600,000, they sometimes will get a guarantee for the whole million. Well, doesn't that sound like it replaces to me? But that somehow the SBA works that out. You can't be a nonprofit. It can't be a real estate investment, a passive investment. Up above there it says land and buildings. What that means is it has to be owner occupied. So your own company would own it and occupy it. And this sounds pretty silly, but pyramid sales, I guess Mr. Madoff didn't have an SBA 7, and any illegal activities. Well, who goes into a bank and says, I want an SBA loan because I'm going to open an illegal activity? I mean, that's pretty trite. But there are some parameters listed in there that tell you all about how the rate is based. It's tied to the Wall Street Journal Prime. Lord knows what that is. It's probably going to be negative sometime soon. Its term is generally tied to the life of the asset being financed. As you can see, they'll go to 10 years maximum. Here's the problem with SBA loans. They generally can't be redone for 2 years. Banks generally won't want to redo them for 2 years. So if you're financing in your machinery and equipment and your business is really going fast, then sometimes it's wise to do anticipatory equipping. That is to say, buy, instead of 1 truck, 2 trucks, because you can get them on a 10-year term loan SBA, and you're going to need them within 7 months. I mean, not to be foolish with your borrowing and all that, but if you know full well, in accordance with your capital plan developed earlier, that you're going to need a truck in January and you're going to need another new truck in November, maybe the wisdom is to get both of them at one time, because they generally don't like to redo these. The amortization is the same as the term of the loan. Fees. The fee is very negotiable. I see we've listed a fee in here of 1%, 2.5%, 3.5%. That depends. Sometimes they will waive parts of that, and sometimes based on risk they charge a little more than that. The lender charges 0.25% annual servicing fee on the guaranteed portion. And basically the credit criteria here are sufficient contributions so that you have debt to worth ratio of 4:1. If strong debt service coverage exists, then the debt to worth ratio can be higher. Basically that means it's a judgment call on the lender. They look for 1.2 times debt service coverage. In other words, your projected financial statements show that you have 1.2 times interest earned as projected net income and or historic. They're looking for character. They're looking for strong management. They look for, quote, strong historic performance in the market will offset weakness in net worth. Well, in fact, a lot of people going for these loans don't have strong historic performance in this market except for somebody else. And so that gets to be a discussion item about resumes. I've got 20 years experience with this construction contractor and that construction contractor, even though the net worth isn't quite right. Be aware that these are parameters in this document here that are created based on a recitation by a lender to me. And I've kind of come to the conclusion over the years that these are pretty negotiable. A lot of these are negotiable. Over on the right side, there's a SBA 504 plan, and generally that is used for land and buildings, leasehold improvements, projected software costs, and so forth. Use a SBA 504 for real estate improvements, and so forth. Similarly, industrial revenue bonds there on the right side. This is big projects, 10 million capital expenditure cap, but it's been my experience that they generally don't like to go at anything less than 5 million. Again, it finances construction. I have, however, seen manufacturing companies persuade buyers to accept industrial revenue bonds for working capital purposes, and so forth. You can actually not do it for anything that's not manufacturing. The whole point here was to develop manufacturing. Construction sometimes will qualify and sometimes won't. Generally won't. The rural development bonds and WIDA small business, probably WIDA is maybe the most relevant to us here because it allows for machinery, equipment, furniture, fixtures, and inventory. Inventory includes construction work in process. WIDA's been up and down, and in the last year has been a little bit down regarding what I'll call working capital lines. They generally want businesses that exist, not new ones. Got to be at least a year old. They're trying to finance development and growth of existing proven enterprises. So the culture of WIDA is to go for enterprises that have existed for a little bit longer time. The interest rates are higher on a WIDA loan. They tend to be 2.5% to 3% higher than prime, and the life of the asset tends to be, the financing period tends to be longer term. So if for whatever reason you want to get, instead of 10 years, 15 years on a crane or a heavy piece of equipment, a WIDA loan might be the way to go. This sheet is a tool for you. Yes, please, go ahead.
I checked into some of these and on the internet, and it looks pretty involved in how you apply for these. Is that true, or is there some simplistic way of applying for this, and how long does it take for them to get back to you that you've been accepted?
Okay, two questions. First of which is, these look like, from observation of what's prescribed on the internet, like they are difficult or time-consuming and paperwork involved loans to apply for, and then secondly, once you apply for them, how long does it take to get them? All right, first of all, with respect to SBA loans, they are not all that involved, and frequently the documents that are required for an SBA loan are the same that are required for the lender. In fact, it's been my experience that the primary bank lender in an SBA loan case makes the recommendation to the SBA, and the SBA's attitude has pretty much been, if you're willing to make the loan, we're willing to underwrite it, assuming you've done all your homework, which is, as we discussed earlier in this course, financial statements, projections, apparent ability to repay, is all done. They have forms to use to do that, but they really aren't much more complicated than what the bank would require anyway. Personal financial statements, corporate financial statements, budgets, cash flows, and a statement of personal history, which credentializes the owner-manager as capable of accomplishing the plan. As for industrial revenue bonds, yes, industrial revenue bonds are certainly more involved, and they require cooperation with the state and municipality, but that's why they're generally reserved for bigger lending. WIDA loans require pretty much the same documentation as an SBA, except they have some of their own custom forms, but they're not too complicated, they're not too difficult. They generally are a recasting of the forecast financial statements and personal financials for the owners, but they generally don't call for any new information. And usually they're limited to 3 years. That is to say, for the SBA, the direct lending requires 3 years forecasts, budgets, and plans. WIDA requires 3 years, but most of them, that's not that difficult to get, because we all know the first year you have some degree of certainty, second is by guess and by gosh, and third year is anybody's guess. And that's the way it's written. Timing, turning around, how long does it take? SBA is almost immediate. That's been, I'm going to say, 3 to 5 days or less frequently, depending on the recommendation of the lender.
It's much shorter than what you might anticipate.
Yeah.
So don't avoid one of these, a program like this, because first of all, you're, generally speaking, your normal business banker is involved in the process as well, and they help you out with it. And then there's always a representative from WIDA or the SBA, and their job is to make the loans. So all that they want to do is help you establish that you are creditworthy, and they absolutely will work with you as far as letting you know what kind of a cash flow analysis that they're looking for and things like that. So don't get turned off by what you may see as a lot of different restrictions when you just go to a website on it. They are very willing to work with you. And the only thing is that, you know, very often you have to have enough financial wherewithal that your banker would be willing to consider you for the entire loan. The only thing is, the big benefit is, though, is that if they can get WIDA involved or the SBA somehow to take a second position, they're willing to give you a reduced interest rate because they're not on the hook for the whole project. But the long and the short of it is, it's not that painful at all. A lot of the exercises that you have to go through are good business exercises to go ahead with anyhow, as far as doing appropriate planning for your project. And they're very willing to work with you.
Any other? We're going to move on then. Okay. Now, how do you know how you're doing? Now, there's a group of sheets that you have that are stapled together. I think there are 4 pages. This is an extract. It's actually 2 sets of extracts. The first 2 pages are with respect to new single-family housing construction, non-spec housing, and the second 2 pages are for residential remodelers. Now, the reason that I put residential remodelers in there is because, honestly, there's an awful lot of residential remodeling being done by single-family home builders to survive these days. Excuse me? Okay, it's this group of pages here. Does everybody have those? Yeah, there we go. All right, it's a 4-page packet, and the top page, I think, says new single-family housing construction, or it should say that, or it should be in there. Now, this is an extract of statistics which are used by bankers and lenders when they're comparing you to the rest of the world. Remember, we talked earlier about gross profit, how that's developed. Is that the place where you measure yourself against your standards and your balance sheet and all that? There's an outfit called RMA, which used to be called Robert Morris Associates, which produces a big fat book, and they used to produce it annually. Now they produce it every 6 months, where they get financial statements from their participating lenders, who are bankers and lessors and lessing agents, and they put those in there in order that there's comparisons. You know, they have some benchmarks. Now, this stuff here is from the latest that we have. Since I produced this, I think now we're about a month away from new statistics, which are going to be changed significantly by the last 18 months' experience in the construction business, I'm sure. That said, this is what has been the case. This is when you go to the bank, he goes to a credit analyst, a finance major type of guy who drafts a written report to the executive committee in the bank about your business. And some of the comments that he will make are, the subject business has cash amounting to only 2% of its balance sheet total assets. In the asset category of 1 to 3 million, where this enterprise falls, having 1.2 million of assets, it should, or if it's going to meet industry averages, have 10.4%. That's this top line here. Okay, second column, 1.3 million. 920 reporting entities reported that they had 10.4% of their cash, or of their assets tied up in cash when they were in that size range. If you are different from that, then it'll be incumbent on your lender to explain what caused that. This company is different because it pays its bills faster than the average, its payables turns are faster, and accordingly it gets better terms, makes more money, but carries less cash. Will be something a lender or the executive committee will have to hear from the credit analyst. So that's what's going on behind the scenes. When you submit the loan, the lender has to work up all this analysis work with another person called a credit analyst, and they have to make presentation. They usually only have a half an hour, sometimes less than that, to make the case for your loan. And so they try to help the executive committee by templating you against the standards. I'm not going to go through each line in here, but there are some key things that I want to kind of point out, some trends. Obviously, as the single-family home construction business grows from 0 to 10 million, some trends become obvious. The percentage of cash stays about the same. The percentage tied up in accounts receivable money due from customers rises. Well, that only kind of makes sense. But I think that's also a little bit due to a growing sense of bureaucracy. By my observation, a $10 million construction company tends to be a bit bureaucratic and doesn't necessarily watch its nickels and dimes as close as the owner who started up 2 years ago and is doing $1 million. All right. Inventory work in process, curiously, tends to be about the same. Less at the start, again, because the beginning startup, 49.6% of their assets are tied up in construction, work in process, and so forth, whereas a $3 to $5 million company has almost 60% tied up. Some of that is just less efficiency as you get bigger, and some of it is bigger projects. I don't know if I necessarily buy all the rationale for why it has to proportionately get bigger. I think it's just less time, effort, and attention to the detail on the critical path to keep the job time compressed. So total current assets run to about 80% and pretty consistently through the range. Curiously, fixed assets. Obviously, it makes sense. If you have to have 2 trucks and an end loader and a crane to run a construction company, well, it makes sense that fixed assets as a percent of total assets would be larger for a small company than for a big company because they can get the efficiencies of size and move them around a little better, and they end up with only 10% of their total assets tied up in fixed assets. That's interesting. I wonder if some of it isn't due to operating leasing, and we're going to get onto that here very shortly. Now, I want to give you all of that and know that those are statistics, like them or not, that's reality, and the number of reporting entities is in the brackets above there, 460, 920, 550, and 639. That's the number of entities that actually reported that. So you would say, well, what is this, 2 companies out of New Jersey or something? No, this is nationwide and pretty much a good scatter graph across the nation of hundreds of entities in these ranges. Now, similarly, residential remodelers, I have those back there, but there are way fewer reporting entities. For reasons that I don't understand, way fewer reporting entities in those SIC codes for residential remodelers, way fewer. So I'm not sure about the validity of those statistics over time. I'd want to see more, and I think that there's probably more of a unique situation for a residential remodeler, less standard, because that's such a broad term, than for new single-family housing non-spec. That's just my guess. But I think that that's what that's all about. I want to move on. We've talked about legal structure, capital ownership, and so forth. I just want to make one point on slide B, where to get it. Take the next slide. Okay. We talked about fees for guarantees and documents. I want to talk about S corporation shareholders. This is the most common and troublesome misconception. I have personally overseen changes that precipitated hundreds of thousands of dollars of tax savings by point E, 3E. An LLC, a limited liability company, can elect to be taxed as a corporation. It can further elect to be taxed as an S corporation. That's kind of an awkward way to go about it, but you can do that. Another way is to form a corporation at the outset and have it elect to be an S. Either way, somehow, sometime or other, you may end up being advised to be an S corporation. A couple things to keep in mind. S corporations cannot retroactively determine the shares of profits or losses. They are rigidly tied to the percentage and shares owned. You can't share profits and losses any other way. If you want to, you have to use compensation, which is subject to Social Security tax, withholding tax, and a variety of other things. You may end up in an S corporation in order to avoid duplicate tax that comes with being a C corporation. Or you're going to retain earnings and you want to build basis, and rather than be an LLC, you decide to be an S corporation to leave money in. There are a number of reasons why you might end up becoming an S corporation. And an S corporation is cleverly named, nothing magic. In 1958, when Congress wrote the law, they had already used up subsections A through R, and so they said, well, here's the law, what's next? And they said, well, it's subchapter S. Fine, so now we're at subchapter S. It doesn't mean small, it doesn't mean shareholder, it just means S, because that was the available chapter. Now, this one is a big issue. Two ways that an S corporation can borrow money. It can go to the bank and do what I outlined a little earlier, get $1 million worth of lending, guaranteed by its two shareholders, all right? And their guarantees may or may not be collateralized, and all is well. And the bank says, we have the apparent ability to repay, and we have the collateral to make the loan, so we're justified. All is well. Corporation goes about, does its business, and for whatever reason, because of the aggressive new tax laws and any one of a number of things, it ends up with a tax loss. If it ends up with a tax loss, financed in part by equipment loans from the bank, guaranteed by the shareholders, which equipment, because they wanted you to buy that, is deductible under Section 179 or bonus depreciation and other stuff like that, that loss ends up not being deductible by the shareholder because he doesn't have enough basis in the corporation. So the whole point of Congress's intent to get tax losses out there, giving taxpayers benefits so they'll be induced to buy equipment or do stuff like that, goes for naught because the losses aren't deductible. Why aren't they deductible? They don't have basis. The only way you get basis in an S corporation is by either putting money in directly in the form of capital contributions or purchasing shares, or by lending it directly to the S corporation. Those are the only two ways you get basis. All right? It's the only two ways you get basis. So if you go to the bank and the corporation borrows money and you guarantee it, you're at risk. The S corporation generates a loss, you can't deduct it because you don't have basis. Let's take a different approach. You go to the bank, you're going to have to personally guarantee it. You're going to have to collateralize your personal guarantee. You can't get out of that. You've recited when they're going to release it. How about the bank makes the loan directly to you instead? The bank makes the loan directly to you instead, with the corporation guaranteeing your loan, and the corporation collateralizing its guarantee with its assets for your loan. Now you've put the money into the corporation so that it could buy the equipment. It has a loss. Loss flows through to you. You actually have an operating loss. You may get a refund of the prior 3 years' taxes because you've had such a big loss that you could carry it back. Or you might elect to carry it forward for as many as 20 years under the latest revisions of the current incentives that are in the tax law and those that are proposed by President Obama. You may get that long to carry it forward and use it. Well, that's good news because that certainly mitigates the cost of borrowing, it mitigates the tax effects and so forth. So my point in E is the effect of guaranteed lending and or any kind of lending on an S corporation shareholders basis is way different if the loan is to the corporation with the shareholders guarantee or to the individual with the corporation's guarantee. Hold on to that. One more thing, you can actually change it. If before December 31st you find out that, oh rats, I did it wrong, that's all right. If you have an intelligent cooperative lender, you can go to him and say, oh rats, I did it wrong. I would like to change it. I would like to borrow the money personally, have the corporation guarantee and collateralize the loan. I'll give you all the same collateral. I'll repay the corporation loan. I'll put the money in to do that, and I'll owe you directly. And frequently, they're way more happy with that anyway, because they're actually lending money to you in their minds. You're just using a corporate vehicle. You have the money in, and they're pleased to do that. I did one as late as December 31st a year ago, and the result was losses flew right through to the shareholders, and that's fine. It's one of the rare cases in tax law where the form actually governs the substance of the transaction. Usually in tax law, if in substance what you did was put the money in because you guaranteed it, you should be able to deduct the losses. It's one of the rare cases where the substance does not govern the form. The form governs the substance. The form you take, the formalities of the transaction have a lot to do with the tax outcomes. All right.
Ralph, you may
Yes,
want to touch on what might happen if somebody has loaned money directly to an S corporation and they've taken losses. What happens if the company becomes profitable and they want to pay those loans back
Okay.
to their shareholder?
His point is well made. What happens if you do it this way and you deduct those losses and now things turn around and all is well and you start becoming profitable and you repay those loans? Well, obviously, if you took those losses, you subtracted your cost basis in the loans down. So if you had $1 million loan and you had $300,000 of losses, your basis in the loans is only $700,000. So if you repay $1 million, you now have $300,000 of taxable income, and that's wonderful because that means you are now profitable and you've repaid $1 million. So keep in mind that the basis for the loans actually gets adjusted down if you use losses to offset the loans, and then repayment then means you got income. Did I say that right?
Yeah.
Okay. Okay. But that's a small price to pay. Yes, sir.
Okay. So this gets back to then having a documented loan agreement between yourself and the company.
Yes, absolutely. His comment was, is it the case then that you absolutely have to have a document for the loan to the company? Yes, I'll go so far as to say you should just redo the bank note and put your name on it instead of the bank's name, so there's no doubt about the terms and conditions.
Right, and then you have the agreement between you and a company as well as the agreement between you and a bank. But then the paper trail on the money itself is then monthly the company writes a check to you for interest and payment.
Yes, his question is,
And you have to write another check to
Yes.
the bank for interest.
his question has to do with the formalities of repayment. If in fact you lent the company money, then if upon repayment to the bank there have to be funds available to you to do so, do you get those from the company? And on what terms would those be? And the answer is yes. If you have to repay $10,000 a month to the bank and you have no other sources and you don't want the company to avoid repayment, in other words, you don't want to leave your money in, you want to use the company's money, then you're going to have to get repaid from the company and you're going to repay the bank. And there have to be formal checks. Yes, there have to be actual formal checks. You have to treat your entity just as if it was somebody else's entity. They would give you a check if it was unrelated parties living across the street, and you would pay the bank. They wouldn't even necessarily know what your terms with the bank are. All right?
And then, so the interest the company pays you as part of the payment is then income to you,
Yes,
right?
right. But the interest you pay to the bank is a deduction to the bank. A deduction to you.
All right,
So it's a wash.
okay.
Very close anyway. All right. Okay, we got to move quick on to one of the most fun parts, and that is, gee whiz, instead of using a bank, shouldn't I use a leasing company? In fact, one of the executives over at one of the local leasing companies has the license plate, why buy? When you can lease. All right? And the answer is sometimes it makes sense to lease. Keep in mind, however, that a leasing company works like this. I'm the leasing company. He's a bank. He's somebody who wants equipment. He comes to me and says, I want to lease $1 million piece of equipment, and I'm willing to pay you to do it. Well, fine. I'm willing to lease him some equipment, but I have to buy it. Are you willing to lend it to me on terms that make sense? Yes. Okay, I can make the lease to you. So the leasing company is nothing more than an intermediary between you and the bank. Don't ever think of it as anything more than that. It's merely an intermediary between you and the bank. Or you're using their bank when you don't care to use your own. Now, that said, there are a variety of different kinds of leases. We as accountants identify them basically as only two, capital lease and operating lease. But if you go to the leasing people, they don't talk that way. They talk closed end and open end. In our jargon, what a capital lease is tantamount to a conditional sale contract. Not uncommon, for example, for a office equipment company that has a $10,000 color copier machine that's integrated into your computer system to do a capital lease, where they'll lease it to you for $500 a month, and at the end of the lease, for $1 or 10% of its original price, you can acquire it. You have the right to do that. Sometimes you even have the obligation to do that, at which point in time it is totally yours. Title transfers. That's a capital lease. That's a conditional sale contract. That's not really a true lease. That's not an operating lease. And the same thing can be done with large, big pieces of equipment. However, keep in mind that you're nothing more than the intermediary between you and that guy's bank, so maybe it's better for you to use bank credit. The reason you would do leasing instead of using your own bank is to keep your bank credit intact, which basically means the bank has set some sorts of limits on you that a leasing company and its bank won't set on you. So there's something of an incongruity there. Nonetheless, there are times when even your own bank will say, we have a leasing affiliate and we would rather do that than lend you this money on a term loan basis. The reason being they want their balance sheet to look different, not yours. If you do a term loan, if you do a conditional sale contract, if you do a capital lease, that, while it doesn't use up your lending with the bank, uses up the leasing company's lending, and it ends up being a virtual ownership situation. One thing to keep in mind about those capital leases is that they require you to have insurance, and insurance companies often, for example, you have a $100,000 backhoe. All right, insurance companies often write a fair market value insurance contract. So you call your casualty writer and say, I got a $100,000 backhoe, add that to my list of equipment. He says, is that leased or owned? You say it's leased. He says, fine. And away he goes. But he fails to put a rider in that liability contract or that property contract that says, if this is a piece of leased equipment and it's a capital lease and your responsibility runs to the full original purchase price, not fair market value, then you are what's called upside down in that lease for most of the life of the lease without insurance. So make sure the casualty writer puts a clause in there that says the amount of the insurance is the fair market value of the equipment or the obligations outstanding to the leasing company, the greater. That way you've got it covered. Sometimes they call that upside down insurance, but keep that in mind.
Ralph, I think you may need to reinforce what a closed-end lease is versus
I'm going to get there.
Okay.
He just asked me, what about a closed-end lease or an open-end lease? And it comes right after what I just talked about, a capital or finance lease on this sheet that you have, one page where it talks about the terminology in leasing. We just talked about capital or finance lease. The closed-end lease is a walk-away lease, and that means, quite honestly, that it is a pure operating and true lease. At the end of 3 years for this copier, you don't own it, we get it back, you walk away, you paid your $500 a month, that's that. That's a closed-end lease. Closed-end leasing is generally not done for large pieces of equipment because you want to own it. You want it to be an open-end or a conditional sale contract. You don't want the guy who sold you the equipment to own it after 3 years. Okay? You generally will use a closed-end lease, a walk-away lease, for relatively small purchases, automobiles, maybe trucks, pickup trucks, but not things that are going to have a useful life or usefulness to you beyond the original financing term. So a closed-end lease means a walk-away. It's structured on a net lease basis. At the end of the lease, you lose right, everything goes back to the lessor, and all is well. That's the good news. The bad news is, like I said, along the way, even in a closed-end lease, if the lease has in it that the original capitalized cost is your responsibility throughout the lease, even in the event of a disaster, make sure you have upside-down insurance with your property casualty writer. Make sure you got that one covered. Fair market value, this means, is a term thrown about in leases, Basically what it means is when a seller under no duress is willing to sell and a buyer is willing to pay, but what it usually means is blue book or something like that. You can fight them, you can go get appraisals and all that, but fair market value is a term you want to watch out for. There are some other terms talked about in here. Open-end lease, that's where the title passes at the end of the lease when you do your final payment or the agreed upon residual. Classic case, Mercedes-Benz, $75,000 car, open-end lease. You decide, hey, you know what? That car is going to be worth $50,000 at the end of the 2 years. I only want to pay for the part of it that I'm going to use. I'm willing to take the risk that it's going to be worth $50 at the end. I'm going to enter an open-end lease where I agree to a residual value of $50. I'll take my chances. If the lessor and his banker are willing to make that agreement with you as a lessee, fine, then you go ahead and do that. At the end of the lease, you are often required, virtually required, to pay the residual and own the car or buy it for that, and then you're stuck. Okay? Sometimes that's done with big pieces of equipment in manufacturing places, and sometimes with big pieces of equipment where you really need it and you know you're only going to need it for a relatively short period of time, and you want to build that cost into a bid for a contract. All right? And sometimes it's a way to get a really expensive piece of equipment without having to pay for it, and you know that it's sort of like Abraham Lincoln's axe. You know, Abraham Lincoln's axe, I have it. It's only had 5 handles and 3 heads. It's going to be worth the same thing at the end of the lease as it was at the beginning. Airplanes is another example where because of the maintenance requirements on airplanes, they replace everything on an airplane, engines and everything along the way. So 10 years from now, the airplane is 10 years old, but is it really? You know, it's maybe a better airplane than when it was new. So those are frequently done with open-end leases where high residuals, high fair market values are set, the risk being on the lessee that the value is actually going to be that or more. Okay. Off-balance sheet financing is a pure operating lease. Now that's where, for example, one of the classic cases of a pure operating lease is you have a 6-month project and you want a job trailer. And you don't want to buy a job trailer because you may not get another job like this. So you call up Dick Hartenstein at DACCO, D-A-C-C-O, and you say, I need a trailer, and he will haul it to your job site and you can lease it, and he'll charge you whatever it is per month or per week, and you pay that. You have no rights to the trailer whatsoever. You don't own it. It's a pure lease. It's just rent. And that's where at the end of the term he comes and gets it, and actually he charges you to fix it back up. You build that cost into your bid or estimate for the job. Okay, that's a pure rent or pure lease. Payment on termination is a put. Residual value, you have to be very careful about how that's defined. If it's defined in a lease for equipment as fair market value, make sure the parameters for how fair market value are going to be determined. 3 appraisals from dealers within a radius of 30 miles or something like that. The biggest benefit of leasing is that for the most part it doesn't use up your bank credit, and to a great extent it doesn't really cause an imbalance in your balance sheet, because if you're doing open-end leasing, you're usually doing fixed asset or conditional purchasing, and that's fine. If you're doing operating leasing, it doesn't show up on your balance sheet at all. It goes straight to the income statement and tax return, I might add. We are getting close. Now, ongoing operations plans. I think we kind of covered this along the way. There's one new development that I want you to know about, and that is open account loans. Can we get to that? There we go. Shareholder loans. We talked about documentation, and I guess I've been preaching that all day. I hear myself saying the D word over and over. When it comes to shareholder loans, it's very common for shareholders to have an account on the books payable from or payable to them. And that account balance goes up and down through the year. Remember what I said about S corporations, where the basis in an S corporation is tied to the amount lent to the company? If during the year shareholder loans are more than $25,000 and they get fully repaid during the year, then you can have taxable income because you've repaid the loan, even if by the end of the year you make a new loan. So you need to be very careful about that. And right now, open account amounts by now legislation and by judicial decree are kind of limited to $25,000. Now that's not a big number. So if you have more than $25,000 in shareholder loans, you'll want to make sure you go to the trouble of documentation and avoid the $25,000 limit that's been put in the law, first by judicial and now by statute. The reason you want to do all this is on repayment. You don't want to have dividends. You want to have loan repayments. You don't want to be getting taxed twice when the company pays you back. We talked about special borrowing, government programs, participation lending. This is likely to come up sometime soon. In the 1970s and 80s, especially for real estate, banks got a little bit greedy. They saw opportunities to make a whole bunch of money by developers, and that could be something coming up fairly soon here as this starts to recover, and they'll take advantage of it this way. We can't make you the loan, but we can create a joint venture where we'll allow the development of this piece of real estate for $1 million. We'll put that into the joint venture, and we get 7% interest plus 25% of the profitability of the venture besides. Participation lending. Some might use a different term for that kind of lending. But bottom line is they get a piece of the action, and they thought how wonderful that was until the things all fell apart and they lost money. But this could be on the horizon again. Participation lending can be a godsend, especially at the beginning of a new economic cycle when you otherwise can't get the money and the potential for profitability is the highest. You shouldn't necessarily close the door to it, but be aware that it's been done before and you're creating a partnership, so be careful about how that thing's done. Banks usually will go get $300 to $400 an hour lawyers to draft a participation agreement. Make sure you get one at least as capable to read it on your behalf. Don't be surprised if that starts to come up, even in the context of single-family home construction, where if you're going to make 20%, they want 2%. It's been talked about. I've heard it discussed. Another thing is preferred stock and debentures. Sometimes you don't want debt. Sometimes your friend is going to give you the money and you want to put the money in, but you don't want it to be a debt because you don't want to be in a situation where you have to repay it on certain terms and you can't. So you create something called a debenture, a convertible debenture, or a second class of stock, a preferred common. There's all sorts of terms. Just be aware of one thing. An LLC can't do that. An LLC can only have members or non-members. It can't have preferred members, second class of members, and all that by statute in Wisconsin. If there's going to be equity investment and it's a corporation, then it can't be an S corporation because you can only have one class of stock in an S corporation. You can only have one class of stock. Frequently, an LLC that has become an S corporation will say, well, gee, we're in the habit of retroactively sharing profits 50-50, even though the ownership is 60-40, we're just going to keep that. No. Income sharing and liquidation preferences create a second class of stock, and the result is you lose your S election and you have to pay two taxes, once at the C corporation level and again at the individual level. Bad outcome. So watch out for loans that start to take on the characteristics of stock and or actual stock with preferences in liquidation or income distributions, because those will kill an S election. And bankers will let you do that. Sometimes they'll even suggest it.
One other thing with S corporations, you can have voting and non-voting common stock, though. So that's one thing that you can take into consideration.
Right, but the only preference can be in voting. It can't be in liquidations or profit-sharing. Thanks. I forgot about that. Okay. Trade or creditor financing, and then we're going to call it a day. That gets back to wisdom and integrity. Don't use vendor or trade creditor financing without letting them know that you plan to do that. The fastest way out of business is with a bad credit rating or with bad relationships with your vendors. Shows up two ways. A, they get annoyed and start taking legal action, but worse, they start charging premiums. Laced into their bids and their estimates is extra money to cover your slow pay. Better don't do that. Better get better banking, do a better job with that whole process of credentializing yourself for the bank, your apparent ability to repay and that whole thing, and pay your vendors quickly. Like I said, that's all the way back to the wisdom and integrity thing, you know. Don't make promises that you can't keep.